Hey, good morning, everybody. Happy Monday. I just thought I was gonna show you the gamma scalping simulator. Um, I made it. I basically just vibe coded it in Gemini because it's one of those. It's one of those things that a lot of people ask about. They'll say, they. I just get the sense that when I talk to people, they don't really like understand how gamma scalping actually works. It's not a very hard concept. Uh, but I think it's easiest to understand with a demonstration with like basically the thing that I built was how I always imagined is the easiest way to understand it. I mean, back in the day, you would make this in Excel, but now it's easy to just use the robots. But give me 1 second. I'm just gonna put the link to this in the Discord in case anybody else wants to check it out. Cool. All right. So let me share my screen here. All right on. So this is it. I've shared the link on Twitter and the newsletter and everything, but this is I just call it Delta Hedging Simulation. And you just pick an initial stock price, strike price. We're just gonna use at the money, say 30 days to expiry. This is pretty neat because you could change the implied vol and you could change the realized vol. So you can really see what it's like to buy or sell an at the money option, and then have the realized vol be higher or lower than the implied vol that you bought or sold. The way it actually works in the background is it's basically just using uh, a random walk, like basically using a geometric Brownian motion process uh, that unfolds where the random variable in there is drawing from a distribution that has the realized vol that you specified. So if you say, like, if you said that the vol was uh, 16, then the standard deviation of the daily returns would be about 1%. So that's all that's happening in the background is it's just choosing a stock process that's unfolding at the sampling from the realized vol distribution that you gave. What I'm going to do is actually I'm just going to switch this. I'm going to say the option at the money type is call. It actually doesn't matter if it's a call or a put because you're going to be hedging delta hedging every day. So one quick fun fact just from put call parity: if you were to buy 100 at the money call options and hedge them on a 50 delta, it's the same thing as buying 50 straddles. The payout, like if you were to make those hockey stick diagrams, would be like exactly the same if you held that to expiration. But the point is here, the option type really doesn't matter whether you pick call or put, because we're just picking an at the money, and you're going to just delta hedge it anyway. But what we're going to do is let's just say it's a long option, and we'll just leave it as it is here. Hey, I bought implied vol at 20, and it's going to realize 25, and then let's see what happens. So we just say initialize simulation. So remember, the stock's going to start at $100, and we're just going to keep adding a day. So we just hit next day. Okay. So the stock price here went from 100 up to 102. Call it 102.62. You know what? Let me make this bigger because I don't know if you could see this. All right. So it's just day one. We went from day one, the stock went up about $2.62. So first of all, that's a 2.6% move. And we sampled from 25 vol. So that's a bigger, if it was 32 vol, that would be 2% a day, would be like your standard deviation of your move. So a 2.6% move is bigger than even a 1 standard deviation move. It's not as big as a 2 standard deviation move, but it's bigger than 1 standard deviation move. And so it's a big move on the first day. So we expect to make money delta neutral, right? So we see that here, that this is our daily P&L. We end up making 19 cents on it. And then we're going to, basically, this is going to be your running P&L over time. This is going to be your daily P&L for that day. And if you go down here, this is the table. The table is super helpful for like debugging your understanding. So now you can see what happened here is like the initial delta, the call, the at-the-money call was 51, just a little over 51 delta. It's not quite 50 delta. Well, you know, I have a blog post called Lessons from a 50 Delta Option, which kind of explain why the at-the-money option is not quite 50 Delta. So the initial call price, if you're using a 30-day option, 20% vol, implied vol, is $2.75. So what you can imagine is you own this call, and then you're short 51 shares against it. So you own one call option and you're short about 51 shares against it. And that's what the shares held is, right? So on day one or day zero, whatever, your initial delta is zero, right? You're long a 51 delta call, you're short 51 shares of stock. So, and this is just where you put it on, right? All the P&Ls are zero. Okay. So what happens? On the first day, the stock goes up 2.62%. Right, so stock's now 102.62. Your calls go up they go from 275 to 429. Right now, obviously there was some gamma involved here too. We don't even talk about gamma, but like that's why the delta of this option, like this 100 call that you own, is now more in the money than it used to be. So it's net because now it's a 66, almost a 66 delta option after the stock goes up $2.62. So there was the delta of the option increased by 14 over this move, right? Your call option went up from 275 to 429. And so you made money on the call, right? You made $1.54 on your call option. And remember, you were short 51 shares and you lost $1.35 because you basically rode a short 51 shares up $2.62. So you used $1.35 in your shares. Your net P&L for the day is 19 cents because you made more money on your long call and your short stock. And then what happens is you need to rebalance, right? You're long a 65 delta call and you're only short 51 shares. So the presumption here that's embedded in this is now at the end of this day, I'm going to sell 14 shares, right, to get back to delta neutral. And I'm going to be selling those 14 shares at 102.62, right? So mechanically, because you were long options, you had to sell stock as like when the stock went up, you had to sell. So you sell high, and you know if the stock were to drop, you'd buy. But in this case, right, you're going to sell some more shares after the stock goes up, and now you're back to delta neutral again. So this is, and by the way, like this is net of I want to be clear, like this is net of theta, right? Because yes, the call price moved up from 275 to 429 due to delta, but we did roll the day ahead one, right? So now this option is at 29 days to expiration, not 30. So when we reprice this call option, it's 429, but that's net of the fact that we have one less day, right? So that there is theta embedded in this. So you made 19 cents on this position net of theta, okay? All right, so then we just run the next day. Okay, stock drops now. Where did the stock go? So hover over this. You see the stock dropped to just about 101, right? Stock dropped about $1.60. We go down. Let's go down to the table. That's the best place to see things. So your call option, you're going to lose on your call, right? Because your call option that you owned that was $4.29 is now only worth $3.25. So you lost $1.04 on your call. But remember, you were short 65 shares of stock, and when the stock dropped, you made $1.07 on those 65 shares. That's your P&L being short 65 shares and the stock dropping $1.62 here, right? So you ended up, look what happened. You ended up making money. Your total, your option P&L was like you lost $1.04. You made $1.07 on your short shares. So this is just rounding. That's why it says 2 cents here. It's like rounding in the 107 and the 104. So that's why it doesn't say making 3 cents. So you end up making, say, 2 cents here. So now, and then your running P&L total, again, like rounding errors are kind of accumulate a little bit here. So you go from a running total P&L of 19 cents to now it's 22 cents. And then we see it up here in the chart. Okay, stock went up, we sold. That's the red triangle. And then the green triangle here is we bought when the stock went down because we had to buy back about 7 shares, right? Because we were short 65 shares. Now our call options only got 57 delta. So being short 65 shares is too much, right? So we need to buy back about 8 shares to get back to delta neutral. So at the end of day 2, we still own this call option, and now we're short 57 shares of the stock against it to be delta neutral. And then we can see our running P&L total. That's the 19 cents. And then we can see, and then again, this is our daily P&L. So on the first day we made 19 cents, and the second day we made almost 2.5 cents. All right, we run a day again. Okay, stock went down again. Okay, so again, we go to the tables because the easiest place to understand. Oh, now the stock's dropped below the strike, right? The stock actually made a big move lower. Again, we've dropped $1.68 from 101 to 99.32. The call dropped from 3.25 to 2.33. So that's the call dropping due to the change in stock, and also, of course, it's decaying because we went from day 2 to day 3. So your daily stock P&L, so you lost 92 cents on your option, but you made 96 cents on your short shares because you were short 57 shares. The stock dropped $1.68, so you made 96 cents. But now you're short, your option delta is only 47. So now you need to buy back more shares, right? Being short 57 shares against a 47 delta call is being short too many shares. You're net short. So we have to buy 10 shares to rebalance once again. So we'll be delta neutral again. And we actually made money on that day as well. And by the way, the fact that we're making all this money is not super shocking because we bought vol at 20. Remember up here, we bought vol at 20, and the realized vol is 25%. Is 25%, right? And we still have lots of gamma because we're still around the strike, right? So and we can tell because the delta is is sort of like around 50. So there's plenty of gamma in this option that we own because we're actually just went through the strike, right? So you can see that the gamma effects are really large. If the stock starts to trend in one direction, you're going to see how that gamma kind of like goes away. All right, so running total P&L now is we're up 25 cents. Let's roll the day forward again. So what we've done is we've sold stock. Initially, we sold stock to be delta neutral. Stock went up, we sold shares. Stock went down, we bought shares. Stock went down, we bought shares again. Okay. And if you notice, what we've done is we've sold stock at 102.62, and then we've bought some back at 101. We've bought some more back at 99.32. Okay, let's roll the day forward again. All right, stock upticks. Okay, but now this is a relatively small move here, right? Compared to the moves that we've been having. The stock went up only $1.04, right? From 99.32 to $100.36. So the stock went up $1.04. So our call option went up by about that's 47 cents. Okay, kind of in line with its option delta. It's got a new delta of 53. So we made money on our calls. We made 96. We lost. Daily option P&L here is. Oh, dude, this is wrong, man. This is like Is this? Oh no, I'm sorry. I got to look at this row. I'm sorry. I'm just off. Your daily option P&L. You made 47 cents. That's kind of what we said before. Right? I'm just looking at the wrong row. I'm sorry. Your daily stock P&L. You lost 49 cents, riding 47 shares up $1.04. You lost 49 cents. Net for that day, you lost 2 cents. So the stocks move, right? The change in your call value was not enough to compensate you for being short for the short shares. You needed a bigger move to make money on this. So we end up losing 2 cents on this. And we see that here, your daily P&L for that day. So you kind of start to get a sense like, wait a minute, if I'm long as option and the stock doesn't move enough, I don't make enough money on the change in the option value versus the change versus my short share position, right? Like the stock needs to make a large move for me to actually make money. Or it has to make a move that's overcoming the fact that this day is moving forward every day and there's theta on this option, right? So now we've sold stock, bought stock, saw an uptick, sold stock. If you were to sum up all these share P&Ls, right? You get all these share P&Ls here. You see that all these share P&Ls are positive, right? We just eyeball this and see that that you're making money on it's like 206. Yeah, so you're making somewhere around 21 cents on all of your stock P&Ls, and I'm only pointing that out because what it's showing you is that mechanically being long gamma is I'm always selling the stock high and I'm buying it low. When it goes up, I sell. When it goes down, I buy automatically, right? So being long options gives me that superpower, right? The cost of the superpower, of course, being the theta of this option. If those moves aren't large enough, I'm going to end up losing to all this. But so far, the moves have been large enough, and it's by design, right? Like I picked 25 fall for the realized. Let's roll the date again. Oh, okay. Looks like a large up move. Let's go back to the table. Yeah. So here we got more than almost a $2.53 move, right? So the stock went up from 136 to 102.89. So our options go up by over $1 on that move, right? From 47 cents to they go up. We make $1.49. They go from 280 to 429. We make $1.49 option profit. We lose $1.35 on our stock. We net made 14 cents that day, which is a really good day, right? Look at all these other daily P&Ls. It's the second best day so far. So, and now this call Delta is 68. Okay, so we're long a 68 Delta call and we're short 68 shares against it. Okay, so sold, bought, sold again. All right, our running P&L continues to climb. Let's move it forward again. All right, small down day. Okay, we've got a small down day here, right? So yeah, the stock dropped only 34 cents. So that's going to be a loser, right? Because our call option is going to go down by a little bit from 429 to 402, but we don't make that much money on our shares, right? Because we're short 68 shares and their stock only dropped 34 cents. We make 23 cents on our shares. That day we lose 4 cents. So we go up here, see that's a loser because that move wasn't big enough. That this is a small move, small P&L, losing P&L here. Or our cumulative P&L declines a little bit. All right, let's keep going. Another small down day. That's going to be another loser. There it is. Another loser. Lost 4.5 cents that day. Another down day. But it's too small. Stock only dropped 22 cents, right? So we lose a nickel on that day. Okay, it's all the same logic. Every single day, it's just the same logic. And now we've got a week or so has elapsed here, 7 days. Let's keep ticking it forward. Okay, we got a nice up day here. You see that daily P&L, we make 6 cents. that day because we got to get a nice update on stock going from 102.23 to 104.13. It's $1.90. Let's just keep kind of moving it forward a little bit. All right, big down day. One thing that's happening here is like this stock actually isn't trending anywhere. It's moving around a lot, but it's staying relatively close to the strike, which is maintaining the fact that we actually have gamma. One way to understand that is that our delta keeps changing. That's the evidence of gamma, right? Is that your delta keeps changing because gamma is the change in delta for the change in stock. So your option delta keeps on changing. But if this stock were to just start to take off and it goes to like 110, 115, it's basically going to be like 9900 delta call. And, if the stock goes up 50 cents or down 50 cents, it's still going to be a 99 or 100 delta call. There'll be no more gamma. There'll be no more adjustments, and your P&L will just be flatlining basically every day. There also won't be much theta left in the option because it's almost, it's basically all intrinsic value. So there's no theta either. So you won't be making any money from gamma. You won't be losing any money from theta either. It's just at that point, the position basically looks like stock, like just a stock position. All right, we'll keep going. Okay, small up day. That's probably a loser. Yep, it is loser right here. I'm just looking at this chart, kind of get a feel for it. All right, that looks like a decent size down day. Yeah, we basically broke even, right? It looks like it's about the distance you need. Next day. All right, big down day. That's going to be, that looks like your biggest winner, right? 29-cent profit that day. Now, actually, let me see something here. This could be kind of cool. So here, that's a big down day, right? So we dropped, I want to point something out on that one, which is kind of neat. So here we dropped, let me not screw up my math. Actually, we dropped, that's our biggest down day. We dropped $3.14, which makes sense that we would have our biggest gamma P&L day, or, hedged P&L day. We make 29 cents that day, but that was also our largest move. And this is the smallest delta that we end up with, right, on this. It's now only a 36 delta call because it's now more than $2 out of the money, but time is ticking on this thing. So it's got a little bit more than half of its life left. But that was our best day so far. You've now made 70 cents on this option. I'm not accounting for any trading costs or anything like that. But you've made 70 cents on this option, and the option's value, right, on day zero, it was $2.75. You've now made 70 cents on an option that was worth $2.75. So like this has been an unbelievable vol buy, right? It's an unbelievable vol buy. Making like the return on this option has been amazing so far. And the crazy thing is like, remember, this is why options is really about vol trading. The stock was $100 when you started. You bought a call option and you hedged it every day, and you've made 70 cents on a $2.75 call. But the stock's actually, lower than where you bought the call, right? So the fact that it was a call doesn't matter because you're hedged, right? So you basically bought a straddle synthetically. Okay, let's just keep going. Sorry, up here. All right, small down day. It's going to be a loser. Okay, it's small down day, but what's the delta of this call now? Now it's down to a 33 delta call. The stock's down to 97.64. Another small down day. Just keep ticking it. Small up day. So you're getting all these negative P&Ls here, right? The moves are just too small. Next day, you're basically flat. That's going to be, you've had you've had 4 bad days in a row, right? Because the stock's just not moving. It's kind of like had that big drop, and then it's just kind of living there. Small uptick. All right, resuming the downtrend, new lows. We get a big move, and we get a big P&L in the stock, right? We're making new lows down here. The stock dropped more than $3 once again. Drops $3.23 on that day, and we made 34 cents. on a hedged position, right? So, but now your call only has 13 deltas. So, you own this call, you're only short 13 shares against it, right? So this call is getting further out of the money. Its Greeks are declining, its delta is declining. It's got less gamma here, even though we don't publish what the gamma is on this thing. This option has less gamma here. In other words, it takes a larger stock move than it has been to be able to move this delta around, right? Let's keep moving it forward. Okay, flat day, small loser. Yep, you lose 3.5 cents there about. Small uptick again. Yeah, this thing really kind of is like a magnet to the strike, it's staying. It's not. It's like this thing hasn't trended away. We're still within $4 of the strike. Let's just keep going. Oh, right. So now we're heading back up again, and you get another good day. You get another big day here, right? Where now you're making 21 cents on that day because the stock goes from 96.29, basically rallies $2.71 to get up to 99 bucks, and you make 22 cents. Now I want to point something out to you here real quick. It's kind of subtle. If you remember in the beginning, we moved $2.62. Here you moved about the same amount. You moved $2.71, right? Pretty close difference. Your delta, look what happened to your delta here. Your delta increased from 51 to 65 on that option. So for that size dollar move, you had about 14 gamma, right? Like your delta changed by 14 on that move. Here, look what happened. You have a same size move. You have the same size move, roughly. And your delta, increased from a 17 delta call to a 40 delta call, right? So you picked up 23 deltas. So your gamma over a very similar size move was 23 instead of 14, which is a pretty big difference. Why? It's because it's true that as you get further from the strike, the option has less gamma as you get further away from the at the money, but gamma really starts to rise as well if you're when you don't have that much time to expiration. And now we're almost a week out from expiry. So this option, I like to say, is like when there's very little time to expiration, we're not down to 1 day or anything, but like we're a week out. This option is pretty close to at the money at this point, and its delta is now moving by a lot. It's like, if you think about expiration, like whether if this option is a dime in the money right before expiration, it's got a massive positive delta. And if it's a dime, in the other direction, the option's delta is almost zero, right? So you have these giant swings in delta based upon the fact that, like, if the stock is just a little bit above the strike or a little bit below the strike, and there's just not that much time left, right? Like that's like maximum identity crisis for this stock. It doesn't know what it is. It's a confused teen, right? So right now, this option's got a lot of gamma. Okay, so these stock moves are going to be very impactful. It also has a lot of theta right now. All right, let's tick it again. All right, this thing is now probably looks like it went through the strike. So a $2 rip that went through the strike. Once again, your delta now you went from a 40 delta call to a 62 delta call. You made 13 cents on that day. And by the way, look at your cumulative P&L at this point in time. You've made over $1.07 on a $2.75 option, right? But the theta on this option is getting really, really fat. Even if we can't see it here, you could think of it this way. It's got $1.02 of intrinsic value, this option right now, right? It's a $2, the 100 call for $2 has $1.02 of intrinsic. That means it's got 98 cents of extrinsic value. If you think about the scale of our P&Ls every day, like a large P&L is somewhere around 20 cents. Well, I know in the next week, this thing is going to decay. Like if nothing happened, if the stock just sat here for the next week, I know it's going to lose 98 cents of extrinsic value or time premium. It's going to lose 98 cents. So over 7 days, you're talking about 14 cents a day. Even it's not linear, but like just say it was. You're losing like 14 cents a day on this stock just sitting here because I know that this call has to lose 98 cents of its value for this if the stock were unchanged over the next week. So it's 14 cents a day of theta, and you put that in comparison to what these total daily P&Ls have been, and you start to get a sense of proportion around how big the theta is on this option at this point. Of course, the gamma is also really large, like I said, like the gamma on this option is going to explode. Like if it rips through the strike on the last day, it's going to go from like massively positive delta option to a massively negative delta option, right? But just giving you a sense, we got, 98 cents of extrinsic value left over the next week. All right, let's go. Let's do this again. All right, we downtick towards the strike. This option is going to pick up more gamma. We're getting closer and closer to the strike. Or actually, we're up through the strike. I didn't even notice that. All right, so now it's a 30 gamma on that move, by the way, right? We went from a 62 delta option to a 32 delta option, right? And another big day, right? And that you'll tend to see that, like if you have a lot of gamma on an option and it's just ripping through your strike, that's usually, if you're long that option, it's usually pretty good if it's ripping through. And here we see it. I mean, this option P&L is getting obnoxious, but again, we kind of seeded this thing with like the fact that we're buying vol 5 points below what it's realizing. All right, so sorry, let's take the stock again. All right, small uptick. Man, are we right on the strike here? Yeah, right, 99.51. Okay, not interesting, right? Like that's $1. The stock moved $1.09. It went up $1.09. Not enough. It's just not enough. Like it's not covering the theta on the option, right? You lost 3 cents on this delta hedge position. Okay, we roll it forward. Another small up day, and that takes us through the strike. But again, not a big enough move. Only a 90-cent move. We're going to lose a nickel on this on that day. And then next day, another up day. Man, this thing's gonna go. Okay, that's right. It's above the strike still. 72 delta. It's now 72 delta call. Okay. We lost again. Again, not a big enough move. Only $1.09. Not enough to cover the theta here. All right. Big up move. All right, this stock's going to lose a lot of its optionality right now. This option, I mean, there you go. Stock ripped. All right, so stock went up $3.02, over 3%, but 3% move in the stock. That's it. It's like now it's a 98 delta call. Okay, so 98 delta call. Look at it this way: the call value, right, is 454. The stock is 104.52. There's 2 cents of extrinsic value left in this option, which means the maximum theta on this option is 2 cents, right? That's all the time premium that's left in it. So the theta is gone. We know the gamma is gone, pretty much gone. It's a 98 delta call. If the stock goes, on the upside, the most this call delta can go to is 100. If we just move up any more, or the day, even if we don't move up and the day elapses, it goes to 29 delta. Maybe that extrinsic value basically goes to zero, that 2 cents of premium, basically the value of the 100 put. That's the premium that's left. Like by put call parity, the call is $2 over intrinsic value. It's $4.54 versus a stock price of 104.52. 2 cents of extrinsic value. That extrinsic value is basically the put. That is the value of the put, right? So when the 100 put here is worth 2 cents. If we don't do anything, if the stock just stays unchanged in one day, like that put's going to go to zero, and this call will go to 100 delta. It's just basically stock at that point, right? Which means that there's no more gamma either. So I think that this I think that the movie's over for this stock, for this option. We had a big day on the last day, 41 cent, turned out to be our best day. Running P&L. It's getting a little bit comical. All right, and then let's just see this thing out. All right, we got a small down day. It's probably not going to matter. Yeah, so it's actually good to see this. Stock dropped. The stock dropped 51 cents. The call, the extrinsic value of the call is now just 1 penny. Just 1 penny, right? The stock is 104.01. Intrinsic is 4.01. Extrinsic is the penny. So the 100 put is worth a penny going into the last day. All right, let's run it. And that's it. That's all she wrote. You know, it's funny. I never really run this thing all the way to the end. So I'm glad there's a little simulation summary. Thank you, Google, for being smart. Gemini putting this in there. It's pretty clever. So you got this thing here. Your final P&L, you made $1.65. $1.42 of it was on the total option P&L, right? And that makes sense because the stock finished above the strike. You made 23 cents of hedging P&L, meaning all the average price of all your buys and the average price of all your sells all netted out to you making about 23 cents in stock trading. The realized vol, remember we were sampling from a realized vol of 25, but that doesn't mean we're going to get a 25 vol because we're still drawing from a sample where the mean is 25 vol. They ended up getting about a 27 vol was what we actually ended up sampling from that distribution. So, you know, there's 7 vol points in here. There's 7 vol points in here of excess over the implied vol that we bought. This is pretty cool. We bought the total number of shares that we bought, 1.28 shares, and we sold 1.76 shares. Our average buy price was 98.46. Our average sell price was 101.37. So that's how we had to have gotten to this total hedging P&L. Yeah. So anyway, that's basically just me narrating how this kind of works. You can feel free to do this yourself. You could switch, like I said, you could switch just a long option or short option, and you can really start getting a feel for things by changing the implied vol and the realized vol and seeing how these things kind of interact with each other. You could change the days to expiration, whatever you want to do. Anyway, I hope this was helpful. And hopefully gamma scalping is a little bit easier of a topic by giving you a chance to kind of like debug how it works yourself by stepping through the table. All right. Thanks a lot.